Good morning. Welcome to this webinar. The topic today is tax planning, and this is a part of Algates webinar series. And this series is to just create awareness. So this is the series to create awareness among investors on general topics regarding finance, personal finance, or investment. So very warm welcome to all of you. A short introduction about me. So my name is Nidhi, and I am a part qualified actuary. I have worked in insurance industry for more than 8 years, where I worked with SBI Life and Swiss Re India Private Limited. And I have been a full-time investor for last 6 to 7 years. And I am in Algates for last 3 years, and I am the principal director here. So I am not, like a bit of disclaimer, I am not an expert on tax, and I am not qualified enough to tell you in detail about this. So this is just to create awareness and give you a ready framework kind of thing. So if you want to do anything, if you want to know anything in detail, of course you have to get in touch with your auditor, who would be able to guide you. So let's just begin. So the agenda would be as follows. First, we'll discuss the objective, why we are doing tax planning, why we need to do it. And then we'll just go to the methods. Then we'll look at the provisions of the income tax. What are the deductions and allowances which are possible, and hence what planning we can do. And in the end, we will keep us some time for question and answers where you can ask your questions. So let's move to objectives. So the tax planning basically we do for tax efficiency, right? And it is the base of any kind of financial planning to bring in tax efficiency. And the idea is to minimize the incidence of tax, the amount of tax which you pay. The idea is to minimize that so that you can you can save more and even invest more of that. And it only includes whatever is legitimately possible, legitimately available maximum benefit by using beneficial provisions under income tax laws. And we would not be trying to resort to anything which is not legit. And thinking of finances and taxes at the beginning of the fiscal year instead of leaving it to the last hour. So it is always best practice to do it in the beginning itself. But the trend is that most of the people resort to it at the last hour, in the last quarter, or even the last month of the financial year, where they do things in a hurry and just resort to whatever possible means are available instead of doing it in a thought out way. So if you do it in advance in the beginning of the financial year, it is always better. That is what is recommended. So let's see. So the objectives, fundamental objectives of tax planning. So obviously to save the money, which is assured saving, and you do not need to give to the taxman. So taxman here is government, of course. So the idea is that tax laws themselves provide you certain provisions where you can avail those, you can avail the benefits under those provisions. And if you do that, it is an assured saving. So why not go ahead with that instead of just leaving it out? So it is an assured saving. So we just need to do some planning and do it in a planned manner so that we get the savings, and then no need to give that money to the government. And direct these savings towards investments. So whatever savings we make, we direct these to our investments, and that in turn will lead to building of a corpus, which can be fuel to cater to our retirement needs. And of course we do it in a legitimate way so that we minimize the litigation. We don't get into any legal troubles. So what are the methods available? So here we can plan our taxes in various ways. So these are just 4 ways. Short range tax planning is what mostly people do. So this is where people just try to jump at it at the last hour in the end of the financial year and try to do whatever is possible at that time, and just look at that particular financial year, whatever is their income and whatever they can do within the provisions, and take actions, make investments, and then do the return filing, and yeah, pay the taxes and do return filing. So long term is a little more planned way of doing it. Here we plan for the long term, and we do it in the beginning of the year instead of at the end of the year. And we also see that how it will happen year on year, like in the coming years how it will happen, and also whatever investments we make or whatever steps we take, we do it in a way that we think that okay, we have to not just do it for this particular year, but we have to keep on doing it for the coming years as well. So it is a little the perspective is little broader, the horizon is little broader, and it is a planned way of doing tax management. And permissive tax planning is same thing. Basically it is taking advantage of the provisions which are there in the income tax laws, which help you reduce your tax liability. So you take advantage of those provisions and make certain investments so that you are eligible for deductions, or you whatever allowances are there available, you check them out and just reduce your taxable income. So whatever laws are allowing, whatever is permitted in the laws, you take advantage of that and go accordingly. And the last point is purposive tax planning. So here the tax planning is done with the particular purpose in mind. So it would be more planned, and suppose one example could be that suppose somebody is having capital gains tax in case he has sold out some property, then the capital gains tax he has to pay. So in that case, if he again makes investment in property, again there are certain provisions because of which if he again invests that money into property again, then he does not need to pay those the capital gains tax which arise out of liquidating the previous property. So this particular investment is done keeping in mind the particular purpose. So this kind of tax planning is purposive tax planning. So other thing is that we can use various techniques to reduce the incidence of tax. How we can do it is in first one is income splitting or income shifting. Both are almost similar. So what we do here is that this is mostly applicable to people who are self-employed or having businesses. So they can split the income and give a part of their income to show a part of the income, entire income, for people who are falling into lower tax bracket. So suppose one way of doing it is that suppose husband and wife are husband is transferring the income to wife, so that if wife falls in the lower tax bracket, so just show the income in the wife's name so that the tax liability is reduced. Suppose husband is falling in the income tax bracket of 20%, and wife is not having any income, or she is still in the zero tax bracket, so transfer some income in the wife's name. Then that way you reduce the overall liability of the family, overall tax liability of the family. Or you can transfer it to your children's name, or certain people what they do is they employ their own family members in their business and give them salaries, so that they show it as an expense, and then the tax liability of the business is reduced, and also the earnings which are going, they are going to the family members only. The salaries which they are paying, they are eventually paying to their own family members. So this way you can split the income, but this would not be applicable to people who are kind of salaried. Yeah, so also same way we can shift certain deductions also. And deferring tax is one thing which can also be done. So you don't pay the tax now and you defer it to a later period in time. Here what people do is, usually if they suppose somebody has yeah, same example we can give an example from, say, stock market. So when you invest in stock market and you make some profits, then they come under short term or long term capital gains tax. So what some people do is, they keep on only investing in the market, and they do not redeem anything, they do not liquidate anything. So unless and until you liquidate anything, you do not get any tax liabilities, because tax liabilities only comes when you liquidate and you have some capital gains. So I would request everyone to mute themselves, please. Thank you. Please, everyone, can you mute yourself, because I am hearing some static sound. Yeah, thank you. So here in tax deference, I was saying that what people do is, they keep on only investing in stocks. They generally do not liquidate their stocks, and unless they liquidate and they have realized their profits, till that time they don't have to pay any capital gains tax. So what people do is, they just keep on investing year after year and they never liquidate. So this way they are deferring the tax to a later period of time. So this is also a technique people use. There are many people who just keep on investing and they hardly liquidate. There are many investors like that. So this is also to just do long term investing, and also it helps in deferring the tax to later period. Then of course there are tax deductible expenditures and tax exempt investments which we do, which are the provisions in income tax laws. So yeah, these will help in reducing the tax liabilities. We will see these later in detail during this presentation. So let's just look at some income tax laws in brief. So what does income tax law say? Like, how should you pay your income tax? Who should pay income tax? So Income Tax Act has classified the types of taxpayers in categories so as to apply different tax rates for different taxpayers. So there are 6 categories totally. So individuals, Hindu undivided family, association of person, body of individuals, firms and companies. And again, the individuals are divided into residents and non-resident Indians. So resident Indians will be taxed. What happens is, for resident Indians, whatever is their income which they are incurring in India, and whatever is the income, other income which is global income, both are taxed. And for non-resident individuals, of course, it will be little different, but we would not go into that for in this presentation. And then the resident individuals are again classified into 3 categories. So one is below 60 years of age, which is the first category. And the second category is people aged between 60 to 80. And third is people who are aged above 80. So here for all these people, it is almost similar, but the tax slabs which apply are little different. So we will mostly focus on individuals who are less than 60 years of age, that those resident Indians who are less than 60 years of age, those are the people which we would cover in this presentation, what they can do for the tax planning. We are not going to cover others, because tax itself is a very huge topic and it cannot be covered in just one presentation. So we'll just restrict ourselves to these people. So now let's see what kind of income people can have. So first category is income from salary, and this would include whatever employed people get, salaried people get from their employers, and even people who are pensioners, they are getting from their ex-employers. So it is basically including salary and pension. Second is income from business and profession. So this would include all kinds of self-employed people and business owners who are doing in a proprietorship kind of thing arrangement. Then freelancers, contractors, or also professionals like CAs, doctors, and lawyers. So these all will come under income for all these people from these professions will come under this head. Then third one is income from house property. So this is rental income which you get if you have a house, if you have a property and you have rented it out. So this income will come under this head. Then fourth category is income obtained from any other source. So it would be something like income earned on bank deposits or any other fixed deposit instruments, or like winning a lottery, like you go on to play a game and you win some big money there. All these things will come under income obtained from other sources. And then the fifth and the last one is income made from capital gains. So this would be having two categories again, short term and long term. So this will happen only when surplus income is made from the sale of a capital asset. So when you are having any capital asset and you sell it, then only you will be liable to pay capital gains tax. Unless you don't sell it, this will not come into the picture. And that capital asset could be in the form of stocks, mutual funds, or even real estate, etc. So these are the 5 sources of income. Now, income tax, you would be knowing that individuals the individuals have to pay tax, and they fall into various tax slabs. And whichever tax slab they are falling into, according to that, their tax liability will be calculated. So now there are 2 regimes in place. Earlier there was only one regime. So now for last 3 years, there are 2 regimes in place. So the government of India introduced this new regime, wherein the tax slab is lower, but then people who are going for new regime are not eligible for most of the deductions. So people can choose any regime, whatever they want, depending on how they, when they calculate the tax, whichever regime is better for them, they can go for that. So these are the slabs. So from 0 to 2.5 lakhs, there is of course no tax. And then the new regime is having 6 slabs. So 5%, then 10%, then 15, 20, 25, and then it moves on to 30. So it is a progressive tax system in India. And old regime is having still 3 slabs. So 5%, and then it moves on to 20, and then 30. So so these are the slabs. And let's move on to next slide. So this is applicable for individuals or HUS, these slabs. So now let's look at the income tax in India, exceptions to the income tax slabs. So what are the exceptions? So all the income put together, you have to calculate all the income, you have to put together, add, and then accordingly your slab will be decided. But there is one category which will be not included in that slab, and that is capital gains. So whatever capital gains you are having, that will not be included in these slabs. That is an exception. So earlier we discussed, right, five different categories of income. So first 4 will be added. One person can have more than one type of income. Suppose a salaried person is there, he can have a house and then he can get some rental income. He can also invest in share market and he can have capital gains. So, and also, of course, he is earning his salary. So he is having 3 kinds of income. So then what he has to do is he has to add everything and then calculate the incidence of tax. But then The capital gains tax is not coming under these tax rate slabs. There is a different calculation for that. So if you are having a real estate property, house property, so if you are selling it within 24 months, then it is a short-term capital gain tax. And if you are holding it for more than 24 months and then selling it, then that is coming under long-term capital gains tax. So long-term capital gains tax on real estate house property is just 20%, irrespective of whatever tax slab rate you fall into. So it is a fixed rate. And of course, short term is coming under your tax slab rate only. If you are selling it in the short term, then it depends on the slab rate. So you have to add it there. And then if you are into debt category, debt mutual funds, then short term and long term is decided depending on whether you are holding it for less than 36 months or more than 36 months. So if you are holding it for more than 36 months, then it becomes long-term investment, and long-term capital gains would apply. So again, here 20% tax rate is there on capital gains. And on that, if you are holding for less than 36 months, then it becomes short term, and then you can add it in your income and just calculate as a and just find out which tax slab rate you fall into, and just do the simple calculation. And for equity mutual funds and stocks, the period is 12 months. So if you are holding any stock for more than 12 months, then it is long term. And if you are holding it for less than 12 months, then it is short term. So long term in capital gains tax only comes into picture if your gains are more than 1 lakh and the tax rate is flat 10%. So whatever is your capital gains in this category, you have to pay a flat 10%. Your tax slab rate will not matter in this scenario. And if you are holding for less than 12 months, then it is short term, and a flat rate of 15% will apply. So your capital gains tax is taxed at a different rate. Yeah. So now again, you have to pay certain cess and surcharges over and above your income tax. Okay. So cess is applicable, health and education cess at the rate of 4% of tax amount. So this will completely depend on the tax amount, whatever is your tax liability. On top of that, you just add 4%, and you have to pay this extra. And then there are surcharges. So if the income tax lies between 50 lakhs to 1 crore, then it is 10%. So this also will be applicable only on the tax amount, not on the income. So whatever is the tax amount, final calculation for the year, on that tax amount, these are applicable. So this moves on to higher slabs as your income increases, as your income increases, and of course income tax liability also increases. So for 1 to 2 crore, if income tax is between 1 to 2 crore, it is 15%. For 2 to 5 crores, it is 25%. And if the income tax itself is more than 5 crores, then it is 37%. And again, there is a in capital gains also, there is a surcharge, and the maximum surcharge rate is limited to 15% in case of capital gains income under section 111A, 112A, and 115AD. So these are the things which you have to pay over and above your income tax calculations. And you have to pay this amount also along with the tax. Not that you have to pay separately. This will ultimately come as your tax liability. These are cesses and surcharges, but of course you have to pay this also along with the tax. Now, how do you pay income tax? So let's just come to that. How do you pay? So the most common thing is you have for salaried individuals, the most common thing is TDS. You would have heard of this term, so very common. So what is this? Your employer basically deducts tax from your salary and then only transfers your salary into your account. Your salary is credited only after deducting the tax. And what they do is they do it from the start of the financial year. So at the start of the financial year itself, in the month of April, you have to give your whatever investments you are going to make, or whatever deductions you are going to claim, you have to give those details to your employer, and then they will see whatever is your annual income for the particular financial year, what is your expected expected total income, rest of the including the income for rest of the month, and then they will arrive at the tax slab in which you are falling, and then accordingly they will deduct the tax and pay the salary to you after deducting the tax. So what happens here is the employer deducts the tax and then pays it to the government, and it goes into of course it goes on behalf of you. Your employer is just deducting it and paying it, but it is going on your behalf, and it is against your PAN. So already you are paying tax in advance. And also banks also deduct TDS if your interest in a particular financial year in the bank deposits is over and above 40,000 in one particular bank, then they will also deduct TDS and then only credit interest to your account, and that is deducted at 10%. And also on professional fee, suppose a company is hiring a lawyer or an auditor to look into their matters, then whatever fee they are paying to these professionals, they have to deduct TDS on that. So that is 10%. Even on rent and so many other things, TDS is there. So basically what is happening here is the tax is being deducted at the source itself from where the income is coming. Okay, so the idea is that you have to pay the tax as and when you earn, not in the end of the financial year or not at the time of tax filing. As and when you earn, you have to pay the tax, and you have to pay the tax in the same financial year. And also Government of India specifies some deadlines that of course in advance you will not know exactly how much income you are going to make it during that financial year. So you have to arrive at an expected income, and then accordingly you have to calculate the tax and you have to pay. So this is the idea, and if you fail to do that, then there are certain penalties. So tax is always to be paid in the same financial year, and it is pay as you go kind of system, which most of the people are not aware of. So most of the people think that tax is to be paid kind of at the time of filing the tax, but it is not like that. It is always to be paid in the same financial year in which you made the earnings, and also it has to be paid along with as the income is happening. So in the beginning only, in the month of April only, you have to assess how much is your expected income, which is what your company is doing for you, and deducting TDS when they are paying salary to you. Okay, and also for self-employed people, they can have a relaxation here because they exactly don't know, like self-employed people or freelancers or professionals, they will exactly not know how much income they are going to have in the financial year, because their income is not kind of fixed and varies depending on the business. So they have time till kind of, I think, 15th March to do that, like towards the end of the year, but they also have to do it in that same financial year. For no one, it is like you can go to the next financial year for payment of taxes, and if you do that, then there are penalties depending on how much late payment you have done. Then there is something called as TCS. This is not very common. This is only for applicable, I think, for people who are doing kind of trading in goods. So they are buying and selling, buying from somewhere and then selling it to somebody and earning some money in between. So here what happens is that a lot of people try to do tax evasion. They don't file properly. So to track the people, to track these kind of transactions, what government has come up with is tax collection at source. So whenever they are buying any expensive goods, then that time from whoever they are buying, that seller itself will collect some tax on their behalf. And there are a lot of items under this list, but usually it will be, if it is bullion, it should be more than 2 lakhs. The transaction should be over and above rupees 2 lakhs. If somebody is buying some kind of jewelry, then transaction should be over and above 5 lakhs. If somebody is buying some vehicle, then if it is more than rupees 10 lakhs, then only these things are applicable, and not applicable to everyone else. But of course, this is to track high value transactions, and just bring those people who are kind of trying to evade tax under the net, and also try to get tax in advance. These two are the purposes of the government to bring this thing. So as and when they purchase, some tax they have to pay, and the rates are very less, like 1%, 2%. There is a complete list, you can find it out if it interests you. Then yeah, the tax, then you have to pay tax in advance, right? You don't have to wait till the end of the year to pay it. So income tax should be paid in advance and not as lump sum. So you have to pay regularly, and there are some deadlines as well. Quarterly deadlines are there. So kind of like you have to pay at least 10% in the first quarter, and then 45% till 45% of your tax liability in second quarter, then 75% in third quarter, and 100% in fourth quarter. That is I think those are, I think, the slabs, but I'm not 100% sure. So it is pay as you earn system. You don't have to wait till the end of the year. And what happens is, at the end of the year, of course, your expected income will not be exactly same as your actual income for the year. So at the end of the year, when you are doing the tax filing, again you have to do self assessment. Again you have to revisit everything, and you have to do self assessment. You have to see whether it is exactly matching or not. So that time you do self assessment, and then whatever, if remaining tax is to be paid, you have to pay that time. Or if any refund is there, then you do the filing, and if you have paid any excess tax, then if you are eligible for any refund, then at the time of filing you have to do the calculation and then file the returns, and the refund will come to your bank account in some time. So this is how tax is to be paid. So let us see what are the venues available to do tax saving. Okay, so of course there are deductions. So income tax deductions are investments made during a financial year that are offset against gross annual income for income tax calculation purposes. So you make certain investments, and these investments are offset. Your income is reduced by the amount for which you have made the investment, and then that's how your tax liability also reduces. So this we are going to do whatever is permitted as per tax laws, and this helps lower income tax, taxable income, and hence lower tax liability. So why government has done this is, whatever avenues are available here for investments, they are usually long term with some lock-in period of 5 years, 10 years, 15 years, or even longer. So this has been done to inculcate a habit of long-term saving, and thus to secure financial future. So government wants you to do some long-term savings by giving you some advantages in terms of tax now, so that your tax is also saved, and you have money also to invest, and you also have some amount which you are putting towards long-term savings and investments. And section 80 is the most popular one here in the Income Tax Act 1961. So there in section 80C, you can have a maximum of 1.5 lakhs, which is what most of the people try to manage. And this is not allowed on income due to capital gains. So capital gains is little different under all the 5 categories. Capital gains is little different. There there you cannot do much, and you have to pay tax in most of the cases. So you don't have any deductions or exemptions there, but of course there are some, you can do certain things, but these things are not applicable. You cannot make some investments in these financial instruments and avoid capital gains tax. So let's look at what is happening under section 80, which is the most common one. So there are a lot of sections here, like if you just even Google, you will find lot of things. So I have just kept whatever is the most common and what you can use, like make most use of. But this is not, of course, an exhaustive list. There are a lot of sections here. So if you are interested, you can check it out in detail. You can even Google it. So section 80 is the most common one. Here you make an investment up to 1.5 lakh rupees per year. And then you can take the deductions and you can do some tax saving. Then here a lot of long-term savings are allowed. Then section 80D is also there, and this is related to health. So whatever expenses you are making towards health insurance and other medical expenses for senior citizens, that is allowed here. Deductions for those are allowed here. And for normal people below 60 years of age, 25,000 is the upper limit, while for senior citizens it is up to 50,000. Then section 80E is there, which is about education loan. So if you have any education loan, this is for people who have just started earning, who have just completed their education and started earning. So if they have any education loan and they are paying any interest on that, and so that is exempted. So available only for 8 years, starting from the year your loan repayment begins until the interest is fully repaid. So this is only for the interest part. You have to take certificate from your bank that how much interest you have paid during the entire year towards your education loan, and then you can take the deduction. And then a section 80EE is there. This is about residential house property loan and availed from a financial institution, and here also you can claim up to 50,000 every year. Then section 80EA is there. So this is specifically for first time home buyers, because government wants to encourage people who don't have any house of their own to buy their first house. So this is for them. So it is 1.5 lakh for interest. Yeah. Then section 80G is there, where if you make any charity to certain qualified institutions, then you get the deductions on whatever donations you have made, and you have to get the receipts also, and there should be proper documentation, and then only you will get these deductions. And depending on the institution, it is, I think, 100% or 50%, depending on where you are putting your money, where you are giving money for charity. So yeah, this is there. And then section 80 TTA is there. Here, if you are earning any interest on bank savings account, which is up to 10,000, then that is that for that you can claim deduction only up to rupees 10,000. If it is over and above 10,000, then you have to pay tax. And then section 80 TTB is there. This is just for senior citizens. They get straight away 50,000 deduction just because of their age in their total gross total income. So these are the most popular ones, but of course there are a lot of subsections in this. So if you are interested, please check them out, and if it is applicable to you, then because these are the most common ones which would be applicable to common people. So I have kept these in this presentation. So now let's look at home loans. If you have any home loans, then what you can do, because this is one category again. Lot of people, this would be applicable for a lot of people. So I thought just I would include this. So there are a lot of categories where principal, interest, and stamp duty are whatever you pay towards these things are allowed as deductions. So under section 80C, as discussed earlier in the previous slide, principal is allowed, and of course 80C has a maximum limit of 1.5 lakhs, and the condition is that house should not be sold within 5 years of possession. So again, for interest, there are 3 sections. So section 24B, then the limit is here 2 lakhs. Section 80EE, here also deduction is there up to 50,000, and there are certain conditions. Then section 80EEA, these also we discussed in the previous slide. First time home buyers already discussed. And also there is deduction under 80C for stamp duty, and of course it is coming under 80C, so 1.5 lakh is the upper limit totally for 80C. And here you can claim it only one time in the financial year in which you actually paid the stamp duty, bought the house and paid the stamp duty. So this would be applicable there in that financial year. So for people who are having housing loan, there are a lot of provisions. So if you have housing loan or you are planning to purchase a house, please go through it or check with your auditor and then file your taxes accordingly. Take advantage of these clauses. So now there are certain exemptions. So what are these? Till now, what we discussed were deductions. Now there are certain exemptions as well. So what is the difference? So deductions are basically, you have to what you have to do is, in deductions you have to make investment or pay extra money to get those deductions. Like you have to make certain investments, and then those investments are counted as deductions. But in exemptions, here you don't have to do any such thing. These are just the components of your gross income which are already exempted from income tax. Okay, so these are already components of gross income exempted from being calculated as a part of taxable income. So this allows individuals to preserve significant portion of their income, and this has been put in place so that people can of course save more. So what would be coming under this? The first and the most important and the biggest chunk is house rent allowance. This is already in your for salaried people, this portion is a big part of their salary. So if you are having house rent allowance, then there are some provisions. You can claim exemptions up to maximum of house rent allowance or whatever you are actually paying. Or if house rent allowance is more than 40% or 50% of your salary, depending on 40% or 50% of your basic salary, depending on whether you are living in a non-metro or metro city, then there are some maximums. You have to you can take up to a certain limit. Your house rent allowance cannot be like 70% of your salary. This is not allowed. For non-metro cities, it is only 40%, and for metro cities it is 50%. And also it depends on the actual rent which you are paying, so you have to provide the actual rent receipts. So this forms a big part, and you don't have to make any investments or anything. This is already a part of your salary, and you get exemption. Then you have some companies will give you food coupons, some will give you mobile reimbursements. Then there is a child education allowance, hostel subsidy. Then one major part is leave travel allowance, LTA. So here also you can claim twice in a block of 4 years. And yeah, this should be a part of your income, then only you can claim. And you have to talk to your HR department and restructure your salary in such a way that it is very tax efficient. So many people who are salaried, who have been paying tax for say last 2-3 years or many years, would be knowing all this, that how it works, right? You restructure your salary in a way that it becomes efficient. So now let's come to the planning part, what we can do. So let's look at the mistakes which people do first. So most of the people are ignorant about what are the tax laws and what are the provisions available. and they just go towards the end of the year, they just try to make some investments and get some tax saving. So they do it in a hurry, and that is not the most efficient way of doing it. And there is lot of ignorance regarding what are the actual provisions. And yeah, there are host of laws and host of provisions, so it is not expected from any common person to know each and everything. But yes, you should not do it out of ignorance. If you don't know, consult the right people and try to do the planning at the start of the year. And then what happens is, when you do it in the end, then most of the people turn to insurance to meet ATC requirement of 1.5 lakh. So please understand that insurance is there to provide you financial protection, and that is the basic idea behind insurance. And the purpose is not to exactly meet ATC requirements. So if you have other avenues where you can invest and you think those will give you better returns, you can of course go invest in those. Or also you can see whether whatever investments you are making, even in insurance products or any other products, to meet ATC requirements, whether they are meeting your long term financial goals or not. So you have to basically look into your needs and goals and check out your long term requirements and make investments accordingly. And this will only happen if you do it in a planned way and not out of ignorance and hurry. Not considering lesser known tax deductions. So yeah, there are so many tax deductions and people don't know about them. So unless you know, you wouldn't be able to take advantage of that. So if you are if you are falling into any category, if you are eligible for any other deductions, please talk to your auditor, please talk to your CA and check out what all you are eligible for and take advantage of everything possible. Only focusing on tax saving while making investments, and this is one of the biggest mistakes which I see people doing. Whenever they make any investments, they only think about tax saving rather than first thinking about where they have to invest and what they are looking for. So investment should be done always according to financial needs and goals, and depending on that you should choose the instruments which suit your risk reward with the risk reward ratio of that instrument should be suiting your needs, of course. So you have to check out all those things before making investments, and not just only focus on tax saving and making only that much investment, and that too only in tax saving instruments. So this could be inefficient way, not in terms of tax saving, but in overall terms of making investments. So please, when you are making investments, don't only focus on tax saving, focus on investments first depending on your needs, and then of course tax saving is of course there. And then many people also underutilize section 80C and 80D. So ATC is up to 1.5 lakh, and 80D many people don't use because this is about health insurance, and of course 25,000 and 50,000 are there depending on your age. So this I have seen most people not using, and this is over and above your whatever investments you are making in whatever premiums you are paying for health insurance. Those are over and above this slab of 1.5 lakhs under ATC, because that is a different section altogether, 80D. So many people don't know this and they don't utilize this one. So please utilize whatever is available to the maximum limit possible, to the maximum whatever you can do and whatever the limit is allowing to do. Now, how would you calculate income tax? So first, what you have to do is every income that you receive in any form forms a part of your income tax return. So whatever income you are receiving in any form, everything has to go into your income tax return. It is not that you leave out certain parts. List down your income, wherever it is coming from, whether it is salary, rental income, capital gains, interest income, or if you have profits from any business or any other, you are receiving any professional fee for any other services you are providing, freelancing or anything. So you have to list down all the things. Then first step is to remove all the income which is exempt under the law. So everything which is exempt, like you get food coupons, so they are exempt. Okay, you have HRA and you are paying house rent. So whatever to the extent it is exempt, you can just take it out. So remove everything, whatever is exempt under the law. So you arrive at the net income again, and then claim applicable deductions available under every source of income. So whatever deductions are available for these, you have to make investments, and you should have the receipts. So whatever investments you have done, if for that you are getting any deductions or exemptions, take a claim for that, and then only you will arrive at your final taxable income. And this final taxable income will decide which tax slab you fall under, and then that will decide your income tax. So this is the process. First you have to check out all your income, all the forms of income which you are receiving, then you have to add them. And of course capital gains is little different, which I have already discussed. Then you have to see whatever is the exemption which is available to you. Then you have to see whatever investments you have done, for that you are getting any deductions or exemptions. You have to subtract all these from your income, and then you arrive at your final taxable income. And only this income, this taxable income, decides your slab and not the overall income. Okay, so this final taxable income will decide which slab you fall into. So suppose you are in a slab between 5 to 7.5 lakhs, then see whether you want to go for old regime or new regime. Whichever regime is more suited and gives you lesser tax liability, you can opt for that. So that is open to you, and you can decide which regime you want to choose at the time of tax filing. It is not that you have to decide in advance. At the time of tax filing only, you can see which is the best regime for you depending on all these things, and then you can decide and file your returns accordingly. So now we are coming almost kind of towards the end. So what you can do in all these things? So what you can do to minimize the incidence of tax? Start by taking your total income, which we already discussed, and evaluate taxable aspects of your income, and understand your taxable income. Make sure your salary is tax efficient through restructuring. This also we discussed, like you can talk to your HR in your company and make your salary structure more tax efficient if your company is allowing that, so that the incidence of tax is lesser, you fall into a lower tax bracket. Then you have to make use of all the deductions. So the most common ones under ATC and ATD, let's look at that them one by one, because this is important. This is the most important part here, because here is what you can do in terms of tax planning. Okay, so under ATC you can have EPF and PPF. So you will have something going to your PF, that is of course coming under ATC. You can invest in PPF, so that also will come under ATC. Then you can put in life insurance, so that also is a part of ATC, whatever premiums you are paying towards your life insurance. Then national savings certificate, then equity linked savings scheme, and tax saving bank deposits. These two also come under ATC. So equity linked saving schemes are special saving schemes. These are mutual funds, but not all mutual funds are tax saving, of course. So these are some special mutual funds. So if you invest in them, you get deductions under ATC. And also there are bank deposits, fixed deposits, in which you make deposits, then you get deductions under ATC. And here you have to here there is a lock-in period of 5 years, so it will be standard 5-year fixed deposit, and you can't break in between. And equity linked saving scheme also, you can't break in between. The lock-in period is minimum of 3 years. So these are all driven towards long-term savings. and investment. So here what you have to see is what is more tax efficient. So if you see like the first three categories, EPF, PPF, life insurance, national savings certificate, if you invest in these kind of instruments, then you get maximum benefits in the term that these are falling under exempt category. So you get 3 times exemption. First, you get the exemption when you are investing. So when you are investing, you claim deductions under ATC. And when you are whatever you are getting interest, that also is exempt. Whatever gains you are making out of these investments, that also is exempt, that is not taxable. And then whatever is the final amount which you are withdrawing at the time of maturity, that also is completely tax free. So you don't have to pay any tax when you are finally withdrawing the maturity amount from these investments. Like whatever investments you make in your PF, or you open a PPF account in bank, so whatever you are withdrawing at the end of, say, at the time of your retirement, you are getting your PF, or your PPF account is maturing after 15 years, or your life insurance policy is maturing after, say, 20 years, you have taken a 20-year policy, something like that, then whatever amount you are getting at maturity, that is also tax free. So there are 3 levels of tax exemption in these. So you have to see what is more tax efficient for you. But in case you go for equity linked savings scheme or tax saving bank deposits, then what happens there is, at the time you make investments, you get deductions under ATC, but whatever returns you are getting, whatever income you are earning income when you are investing in bank deposits, when you are investing in bank deposits, then you are of course earning interest, and that interest is again taxable. It will come as taxable income. So that is taxable again as and when you are earning it. And when you are investing in mutual funds, equity linked savings schemes, then even after keeping for 3 years, when you liquidate it, then you get capital gains, and then you have to pay tax on those capital gains. So these are not those kind of very tax efficient schemes as compared to the first 3. So see whatever is more suited for your needs and whatever is even more tax efficient, and invest accordingly. Then of course health insurance premium is there. This will come under ATD, and this is this is not an investment, this is simply an insurance premium. So utilize it. Of course you are getting health insurance benefits as and when you fall sick and need hospitalization, then insurance company will take care of your hospitalization expenses. So this is also quite good, because we don't know, I mean, when we are going to fall sick and who is going to fall sick, so we don't know all that, and you know how much is the cost of hospitalization these days. So please insure yourself. And then home loan payments, we have already seen this in detail. So this is apart from some are coming under ATC, and one more is coming under section 24B. So this we have already seen in detail. So these are the most popular ones, most popular routes to do tax saving. So check out what is more tax efficient and what is more suited to your needs, and do the investments accordingly. So now what is the final word? Like paying income tax is of course your responsibility as a citizen of the country, right? So taxes we pay are used for our benefits. So if you are earning an annual income which is exceeding 2.5 lakhs, then congratulations, you have moved into a tax paying slab. So this is also a big deal. So yeah, so that means that you are well off compared to most of the people in India. So yeah, so pay tax, and whatever are the legit ways of doing tax saving, please do it in the legit way. Don't resort to any ways which are not legit, and then you can end up having some litigations, you can have legal troubles. So please resort to legitimate ways. Then let's just talk about Algates in brief. So Algates Financial Private Limited is authorized person of Cholamandalam Securities Limited, and of course we are into stocks, bonds, and corporate deposits, corporate fixed deposits. And we have Algates Consulting IMF, which is an insurance marketing firm. So in this we distribute all kinds of insurance products, including life, health, and general insurance, and we do end-to-end financial planning. And we boast on our services, like we have RM based services, and of course these are personalized services depending on the client needs. So this is about ourselves, and you can reach out to us. You can call us, you can mail us, and you can visit our website, and you can also check out our social media handles. We are present almost everywhere on Facebook, LinkedIn, Instagram, and YouTube. So you can check out our YouTube channel where we are very active now. So yeah, let's just move to the questions now. Can we have the slides? Okay, we'll check it out, but these are our slides, so mostly it will be a no. What is lakhs? Lakhs is basically 100,000. Lakhs is used in India. 1 lakh is equal to 100,000. Yeah. Okay. 1 crore is 10 million. 1 crore is equal to 10 million. Yeah, how are dividends taxed? Okay. Dividends are also taxed now. Earlier they were in India. If you have invested in a company and you are receiving dividends yearly, then earlier, like 2-3 years back, dividend income was completely tax free, but dividend income is now taxed. But I am exactly not sure what is the percentage of tax which is applicable, but it is some flat tax rate. I think so. It is some flat tax rate. It is not according to your tax slab, but I think 10% or something, but I am not sure. We'll have to check it out. But yes, dividend income is now taxable. That is there. Yeah, ELSS, I think maturity taxable. Yeah, so ELSS is also a kind of mutual fund only. And when you invest in mutual fund, so ELSS has a lock-in period of 3 years. So you cannot withdraw before 3 years. So 36 months you have to keep. So it will of course come under long-term capital gains tax. Yeah, right. So any other questions are there? We can take them up. Already it is 12:04. So any other questions we can take up in a couple of minutes, or else we'll wind up here. Any other questions, you can unmute yourself and ask, or you can ask in the chat box. Okay, so no more questions. Thank you so much for the appreciation. And please when it comes to taxes, please talk to your auditor and make most use of whatever provisions are available. And as I said, don't resort to any methods which are not legitimate. And yeah, I am not qualified enough to take up this topic, but then yes, this is just for your this is just for awareness purpose, and this is not the final word. So yeah, with that we would like to end this session. Thank you so much for joining in and giving us time. We hope that you are doing good and have a great weekend ahead. Thank you so much, and bye bye.